If you're a business owner and December hits, it's that time when you figure out how much money you've made this year. And you know the drill. Your CPA is going to call, you're going to get together, and the number's going to be big. So today I want to walk you through 3 year-end tax strategies that I've personally used in the past years to legally reduce what I owe. And it helps me keep more of my capital growing in the investments that I want them to be in. These aren't just theories. I've vetted them, I've used them, and I have trusted sources for each one of these. Now, before we jump in, if you don't know me, my name is Kent. I run a growing fund that's helping investors get diversification in alternative assets without all the headaches. There's no cost to join us, and each deal we bring into the fund actually performs better than if you were to go it alone. Okay, so let's look at number one. It's a big one, and most people know all about this one. It's depreciation. Depreciation. This is why people do real estate. It's the silent workhorse behind the scenes. And we start there just because it's the biggest lever that high income investors have when it comes to alternative investments. But there's still a lot of investors that don't realize this. But when you invest in certain real estate deals, especially value add or new construction projects, you can use accelerated depreciation. Now, this is cost segregation, which brings forward all these years of depreciation, speeds them up all the decades into one single tax year. So these deductions produce what's called passive losses, which can offset passive income. Things like real estate cash flow, K1 distributions, private equity gains, and many alternative investments that you're already invested in. Now, that's what most people know, but here's where it can get really good. If you or your spouse qualify as a real estate professional and you can materially or somehow materially participate in these deals, then these passive losses can kind of spill over and offset some active income as well, like W-2 income or business income, the income that we're all trying to reduce. Now, if you're retired, maybe it's time for you to ask your tax guy if it might be time for a new career. Because if you can spend 750 hours a year vetting deals and investing, you may qualify. Now, most people are shocked when they realize depreciation can offset that much tax liability. I've used this for years, and it's one of the reasons I prefer alternatives over Wall Street, because the tax code literally rewards you for owning these productive assets. Number two, we're going to take a look at something a little different. We're looking at oil and gas working interest, and that's key. It's got to be a working interest. This is not a typical oil and gas partnership. I'm talking about a true working interest, which the IRS absolutely classifies this differently. Now, why does it matter? Because a working interest losses are typically treated as active losses. Guess what? That means they offset active income as well. Again, W-2 income, consulting income, business income. So if you're a high earning professional, maybe a doctor, an engineer, or a business owner, an active loss is unbelievably valuable, because most of the tax code walls these passive losses, and keeps them from touching active income. Not this one. You're also going to get some other great benefits. You get intangible drilling cost deductions. You get depletion allowances, tangible drilling cost depreciation, potential ongoing royalties and cash flow as well. That's why we do it, right? I've participated in these personally, and they have been some of my most reliable year-end tools when I need to close that gap between what the IRS wants and what I actually want to pay. And yes, I have trusted operators in this space. Please, please don't just Google oil and gas deals. Did you hear that? Please don't do it. Don't just go find an oil and gas deal by yourself. I can almost guarantee you that it won't work out as you'd hoped. All right? This last one is really, really good. It's called a leverage charitable deduction or contribution. These are just so powerful, okay? So powerful. We all like to give. Hopefully you give, and you give generously. But this one is hands down the most underutilized strategy among high income earners. And yes, it's 100% legal when it's structured correctly. The ideal is really simple. You're going to make a charitable donation, but your contribution is going to be used to buy a discounted asset of some kind. And then they're going to donate that, which multiplies the tax deduction far beyond the cash you personally put in. For example, you might contribute $100, but you could receive a deduction several times, 5 to 10 times multiple bigger. Okay. So while you still get to keep your capital working in other investments, so it lets you support causes you genuinely care about and at the same time reduce your tax bill substantially, keeping your cash flow mostly intact. Okay. Now, these programs do require very careful vetting, and this is one area where I'm extremely picky. I've used leverage deductions personally, and so has my CPA along with me. And I work with a trusted expert in this space who does this at a very high level. Now, this is definitely not something you do yourself ever. Okay. So, these are the 3 year-end tax moves that I've personally relied on in the past. Okay, depreciation, everybody understands it, but maybe it's time for you to be a real estate professional. Passive losses turn into active when you do that. Oil and gas, got to be specific about the working interests, one of the last true remaining active losses in the tax code. And then the secret down here are these leveraged charitable deductions. They're going to keep your capital working while you're doing a lot of good. So again, I have vetted trustworthy sources in each of these categories. That's why I use them. And that's why it's best to invest together and have a group of people who are vetting these things. There's just way too much noise out there for you to be going it alone when it comes to your investments. If you want me to share some of these contacts with you that I use, or you want to sit down and break down a strategy that fits your income type, your investment goals, maybe your tax situation, I'm not a professional. I just love talking about this stuff. I will put you on my email list. I'll start sending you deeper breakdowns about what we're investing in and some of these year-end opportunities. The link to join my list is going to be in the description under this video. I hope you liked it, and I hope you can take some of this information and put it to work this year.